What if the biggest risk in crypto is not the market crash itself, but the moments you cannot even see? A deep dive into 5-minute interval data from 2016 to 2023 shows that Bitcoin and Ethereum react to macro news in fundamentally different ways. Bitcoin shows pre-announcement sensitivity to both US and international news, acting like a global speculative asset. Ethereum, however, is more tied to US monetary policy. This divergence means the crash will not be a single event, but a series of invisible, high-frequency traps set by institutional players long before you get the news alert. And the first warning sign shows up in the data before the news even breaks. The ghost in the machine shows up when price action moves ahead of the clock. Research analyzing Bitcoin's behavior from 2016 to 2023 reveals a consistent pattern. Volatility increases before a majority of the specific US news categories to which Bitcoin significantly reacts. This is not random noise. It is a signal about who sets the tone when important economic data is about to drop. Conventional wisdom says markets react to news. Here, the shift happens before the official release time. This pre-announcement activity strongly suggests that information is not perfectly contained. Some traders are acting on signals, positioning, or leaks ahead of the public. The research methodology uses high-frequency, 5-minute return data from the Gemini exchange, focusing on the narrow windows just before scheduled news events like inflation reports or Federal Reserve decisions. That granularity makes it possible to detect volatility patterns that emerge within minutes, patterns a daily chart would miss entirely. For a retail trader relying on alerts, this creates a fundamental and systematic disadvantage. By the time your screen lights up with a consumer price index release or a Federal Reserve statement, the market has often already moved. The price you see isn't a reaction to the headline. It is the new baseline set by those who acted first. This pattern is most pronounced for Bitcoin, which demonstrates sensitivity to both US and news from outside the US, behaving like a global asset that responds to international economic shifts. What makes this even more notable is how it differs from traditional currency markets. Studies typically find volatility rising after, not before. Pre-announcement. Volatility often shows up in crypto. It increases for most of the significant US news categories that matter to Bitcoin: personal income, new home sales, capacity utilization, the Federal Reserve's Beige Book, and in some cases durable goods and gross domestic product releases that show different timing profiles. That contrast points to anticipatory trading, informed positioning, speculative activity, or portfolio rebalancing by traders looking to avoid announcement surprises. The timing is what makes the trap effective. These bursts can unfold in minutes or even milliseconds, a speed that makes them nearly impossible to capture without automated systems. You are not just competing with other people. You are competing with infrastructure. And while Bitcoin behaves like a global barometer, the trap doesn't look the same everywhere. The next layer of risk depends on which asset you're trading and how narrowly its triggers are aligned. Ethereum's trap is defined by concentration, not breadth. Ethereum shows stronger sensitivity to US announcements overall, with particular responsiveness to US monetary policy and key economic indicators. That focus changes how risk builds and releases. Its volatility is more predictable in its triggers, but that predictability doesn't make it safer. It concentrates the risk around a specific set of US-driven events. The research highlights Ethereum's strong reaction to particular types of US economic data. It shows significant pre-announcement volatility linked to USG/DP preliminary reports, ISM manufacturing data, and Federal Reserve communications like the Beige Book. Compared to Bitcoin, this creates a narrower, but potentially deeper, risk profile. During the pandemic, this pattern intensified. Ethereum's pre-announcement responses expanded to include more inflation signals, such as consumer price index data and housing market reports, and reflected a broader focus on inflation, fiscal deficits, and trade-related news. In crisis conditions, Ethereum becomes more tightly coupled to the traditional US financial system and its policy decisions. For a trader, this creates a paradox. A more predictable trigger might seem easier to avoid, but it also means that when a major US announcement hits, the entire Ethereum market is likely to move in the same direction at once. Concentration increases the odds of crowded positioning before the release, and one-way order flow after it. That dynamic resembles the concentration risk seen in 2008, when exposure clustered around a single sector. Here, Ethereum's volatility is tethered to US policy and macro releases, creating a potential single point of failure. The research further underscores this by showing Ethereum's limited response to non-US news, especially before the pandemic, apart from a notable exception like Japanese industrial production. Another important nuance is correlation under stress. The pandemic period did not just intensify Ethereum's sensitivity, it also pushed both major cryptocurrencies to react more to similar US categories, especially inflation and policy-related announcements. In other words, when conditions worsen, the room for diversification shrinks. What looks like a hedge in quiet markets can converge when volatility matters most. This is where timing becomes the defining risk. Ethereum's narrower trap is triggered in the minutes around scheduled US releases, when information and execution speed dominate outcomes. The mechanism behind that edge is not traditional leverage. It is an advantage embedded in how and when orders hit the tape. Which brings us to the core concept of this section: the high-frequency mortgage, a structure of obligations built not on credit, but on timing, information asymmetry, and execution speed. It is an edge created by how markets process information and how fast certain players can act. In 2008, systemic risk hid inside complex derivatives that few people understood. Today, a similar opacity lives in the microseconds around scheduled announcements. The advantage is institutional by design. Those closest to the pipes see and act first. This dynamic is rooted in market microstructure, the rules and technology that govern how trading actually happens. These systems create inherent inefficiencies. Arbitrage opportunities between different crypto exchanges are constrained by liquidity, fragmented regulation across countries, and latency across venues. Under normal conditions, these dislocations are small. In the seconds surrounding a major news event, they can widen sharply. That amplification translates into profits for fast participants and instability for everyone else. Because crypto trades continuously across time zones and exchanges, there is no opening or closing auction to buffer shocks. The market is always on, and that constant availability increases the chance that price gaps appear and propagate. Regulators like the European Central Bank have flagged crypto assets as high risk, often speculative instruments with public policy concerns. That label matters when liquidity thins and policy sensitivity rises. This system is primed for a liquidity flash event. The pandemic period showed how stress can turn local volatility into a cascade. When panic sets in, the same high-speed firms that supply liquidity can withdraw it instantly, leaving a vacuum. A practical warning sign is an unusually quiet order book just before a major economic announcement. That calm can mask intense positioning that triggers a sudden break the moment the release hits. Another layer of fragility comes from the market's exposure to illicit use. Research estimates that amounts exchanged for criminal. Purposes exceeded $24 billion in 2021, with some studies suggesting up to 23% of transactions may be linked to criminal activity, including ransomware, tax evasion, and sanctions circumvention. This undermines confidence and invites intervention. A regulatory crackdown aimed at curbing abuse could, in a stressed market, pull liquidity and prompt rapid de-risking, not a forecast, but a plausible path given how thin liquidity can be. If you are trying to navigate this, the question is not whether to participate. It is how to recognize that the risk profile has shifted from balance sheets to timestamps. The frame you use next will determine the moves you make. Here is the takeaway and where this all points. The goal is not to avoid crypto, but to see how the risk map has shifted. The 2008 crisis centered on hidden debt within complex financial products. The next crisis may stem from hidden time, the advantage held by those who can act in the milliseconds before public information is released. That shift challenges the idea of a fair and efficient market. The data shows a consistent, invisible edge for a select few with superior technology and potential early access. If you're seeking financial freedom, look past the news alert and study the mechanics operating in the shadows.